हेलो स्टूडेंट्स, वेलकम टू सागर शर्मा क्लासेस। आज हम आपके लिए लेके आए हैं फाइनेंशियल मैनेजमेंट का एक इम्पोर्टेंट टॉपिक। इसमें हम आपको बताएंगे व्हाट इज कैपिटलाइजेशन एंड उसके अलावा जो सेकंड टर्म है वो कैपिटल स्ट्रक्चर है, उसके क्या क्या कंसेप्ट है और क्या क्या बेसिक उसके डिटर्मिनेंट्स होते हैं जो कैपिटलाइजेशन और कैपिटल स्ट्रक्चर को इफेक्ट करते हैं। तो वेट, सबसे पहले ये आपका हम बताएंगे कैपिटलाइजेशन। इससे पहले हम पेन ले लेते हैं, 1 मिनट वेट करिएगा। यस। सो व्हाट इज कैपिटलाइजेशन एक्चुअली? Capitalization is a process. Capitalization is a process. Okay. Now, what is this process about? Capitalization refers to the valuation of the total business or the total fund invested in the business. Actually, the according to the Guthmani and Dugal, capitalization is the sum of the par value of outstanding stocks and the bonds. It includes the borrowed fund and owner's fund, including surplus earnings, if any. In simple words, capitalization is long-term loans plus debentures plus share capital plus retained earning, and alternatively, capitalization can be also calculated total assets minus current liabilities. So it means capitalization include long-term loans, debentures, share capital as well as retained earnings basically. What are the theories of capitalization? There are mainly two theories of capitalization. First one is cost theory, second one is earning theory. So what is your cost theory says? Cost theory, according to this theory, capitalization or the value of firm is arrived by adding three things: cost of fixed assets, cost of establishment, and permanent working capital in the firm. After that, the second theory is earning theory. What the earning theory says? According to this theory, capitalization or the value of firm depend on the volume of earnings and the fair rate of return or the rate of return of the industry. So the amount of capitalization is arrived at by following formula. Capitalization will be equals to estimated earnings upon fair rate of return into 100. Let's take an example. If the estimated earnings is 1 lakh rupees and your fair rate of return is given 5%. Okay, we just take an example. So what is your capitalization? Can you calculate 1 lakh upon fair rate of return is 5%? So we can write 0.05 into 100. Calculate it and find your answer. What will be your answer? 1 lakh is your estimated earnings. So your when you divide it, when you multiply both 100. So here is 5 in denominator, 20. So it will come how much? 20 and 2, 1, 2, 3, 4, 5 zeros. 1, 2, 3, 4, 5. It means 1 tens thousand, 10,000 lakh, 10 lakh crore. 2 crore is your capitalization. So this is the formula. And the second formula is average amount of profit upon fair rate of return into 100. Estimates of earnings and rate of return of the industry must be accurate. Over and under estimates of earning may lead to over and under capitalization, and over and under assessment of rate of return of the industry may lead to under and over capitalization. After that, what is capital structure? Capital structure normally known as debt equity mix. What is the debt proportion in your capital structure and what is the equity proportion in your capital structure? It is decided by capital structure. Refers to mix of long-term sources of funds which comprises of borrowed funds as well as stockholder investment. It means shareholders fund. It is the composition of various components of borrowed and owned sources of capital. It includes long-term debt, debentures, share capital, and reserve and surplus. What is symbolically represent? Capital structure equals to long-term debt plus debentures plus preferred stock. It can be preference shares and net worth. Net worth means equity holders fund, equity capital plus reserve and surplus. After that, what are the determinants of capital structure? How you determine the capital structure of a firm? There are various factors which affect the capital structure. First one is nature, size, and characteristics of the firm. Nature means if your business is seasonal, we can say seasonal. So what is your capital structure? Your capital requirement will be less in comparison to continuous production because you don't need continuous 12-month production. Like this size, if your business is a small size, then your capital requirement will be less. And the characteristics of the firm, it also depend on the capital structure. Second one is life cycle stage of the firm. Life cycle, like the if you read the product life cycle, firstly introduction, growth, maturity, decline. Like this type, what is the life cycle stage of the firm? Firm in its which phase of its operations? It is a growth or decline. Then also depend This is also a factor that determine the capital structure. What are the volumes, growth, and continuity of sales and earning? If your volume, growth, and continuity in sales, then your capital requirement will be less. Interest rates, if your debt interest rate is less, then you will prefer debt. Cost of capital, what will be the cost of capital of various sources of finance? If the cost of capital is less in case of debt, then you will prefer debt. Tax rates, what are the tax rates? Because you know debt is the tax advantage, cost of capital. Okay, desired degree of flexibility, desired degree of control. If you want more control, then you will not issue equity shares, because equity shareholders dilute your ownership control. Duration of fund requirement, investor preference, and capital market conditions also play an important role in deciding the capital structure. What is the degree of financial leverage, availability of funds in money market, legal requirements, condition imposed by big finance, venture capital financer, and angel investors? These are the people who provide finance for your firm. At last, what are the qualities of a good capital structure? What is a good capital structure actually? First one, optimal capital structure consists following qualities. It should be manageable cost of capital. It should not be more than or less than with the actual rate of return. Manageable degree of risk, it means adequate financial leverage. You should not bear extra interest cost if you borrowed more debt in your capital structure. There should be adequate flexibility in your capital structure. There should be proper control of management, maximum return and maximum value of firm. Optimal capital structure is that capital structure which gives you maximum return and maximize your value of firm. Simple and easy to understand. Minimum restrictions of lenders and financiers. Safety of investment and commensurate to legal requirement. Your capital structure should be commensurate to legal requirement. It should not be illegal. So thank you very much. If there is any doubt, you can ask in the comment section. Yes.